Hey folks, Don DeRosa here. Got another video for you. Let me see what the question today is. The question today is, how does a mortgage impact your real estate investment returns? That's actually a pretty good question. So I'm going to try to explain it as simple as I can. Anytime you use, well, let's talk about return on investment. When you put your cash out, it's your investment, right? So whatever the return gets on whatever you put in it, that's your return. That's your ROI, return on investment. So when we start talking about using leverage or using a mortgage or a loan, it reduces the amount of cash you need to put into it. For example, I have some numbers. Now, when I tell you these numbers, I don't really want you to pay attention to the numbers as much as the concept of return of your investment versus leverage. Let me give you an example. I have a house that is worth, fixed up, $100,000. Now, try to follow these numbers without a piece of paper, or if you can take a piece of paper if you wanted to. So I have a house that's worth 100. So here's the value of the house up here. I buy it for 55,000. Okay? And I put 10,000 in it. So I'm into that for 65,000. By the time I have some closing fees, we're going to say I'm into it for $70,000 or 70% loan to value ratio. So whatever debt's on it, that's your loan to the value, which is 100,000. That's your loan to value. So if I'm all in for 70, my loan to value ratio on that is 70% because my house is worth 100. So think about this. I have $65,000 worth of cash or $70,000 worth of cash in this deal. So I've got $30,000 worth of equity, or my return on that would be somewhere around $30,000. Well, it's not really that, because then you've got commissions and closing fees and so on and so forth, which shrink that. So we're going to say it's my return or my profit's going to be somewhere around 23,000. Okay. So if you did the numbers on this, that's about what it would come out to if you paid a 5% commission. So my cash all in on this would be close to $70,000. My return somewhere around 25,000 after I pay some fees. Okay, so my return on investment on that is going to be somewhere around 33%. Okay, so that's if I use my cash. I spend $68,000, close to $70,000 on that property. Now, if I take, let me move this over, and I leverage that property, and I go out and I get a loan on that property, instead of paying $55,000 for the purchase price, I'm going to borrow that money from someone else. I'm going to borrow that money, and I'm also going to borrow the $10,000 that I'm going to put in repair. So I'm going to borrow all that money. So at the end of the day, all I've got to put into this is a few $1,000s out of my pocket. My return is roughly the same. You know, on the one I did before where I have some where I put all the cash, I've got additional interest that I'm paying on that, because I'm paying more money, I'm borrowing, you know, I'm putting more cash into it. Okay, so I've got, but when I leverage this and I borrow every penny of it, yeah, let's say I borrowed at 10%, my return is roughly the same, or my cash profit is still the same, but my return on investment, my return, because how much money do I have? I've leveraged the whole thing. I have very little cash in this at all. So what is my return? My return, if I put cash into it, was 33%. If I used leverage from a bank or somewhere else, I have none of my own money in it. My return now becomes somewhere around 190, almost 200% return, because I have zero cash or very little cash out of my bank account in this deal. So when you start looking at returns, so let me get back to the question. Let me It says, how does a mortgage impact the real estate investment return? Anytime you can use other people's money and leverage other people's money, that's less money that you have to bring to the table. And as long as you do your numbers correctly, you're still buying it at the right after repair value, you're still buying it at the right loan to value ratio, you're still buying the numbers at the same dollar amount, your return is always going to be substantially higher if you leverage other people's money. That's just a fact. So that's how leverage works. In a perfect world, you want appreciation, you want leverage, which will over time give you equity, all that type of stuff. So the more you can leverage a property and not put your cash in it, the better it is. So I hope that, I know that was a lot of numbers to you and without having those numbers in front of you, but go back and listen to it, put the numbers on a piece of paper and do the math, and it might make a little more sense to you. But from an investment standpoint, a mortgage is always going to impact your deal much better. If you can qualify and you can get the mortgage and you can leverage your properties, you're always going to have a better return than if you just put your cash in, because you're leveraging other people's money. Keep your cash, put it somewhere else that gives you a higher return. So hopefully that helped you. Hopefully that answered that question. I'd love to hear any comments that you have, questions you may have. Put them down in the comment section. If you're watching this on YouTube, hit the notification, hit the subscribe button. If you're watching it on Facebook, hit the like button. Give me some comments. So I appreciate any feedback that you give me, and it helps me figure out what's the next question to answer. So until next time, this is Don DeRosa saying thank you very much. Have a wonderful day.